This week, in fact, it was up, not down. At the same time, the market has clearly been nervous. How do you approach this? And particularly, I read with great interest, you're talking about a so-called growth trap.
Yeah, I think, as a value manager, one of the things that happens to us all the time, a client comes in or a prospective client comes in and says, oh, you buy value stocks. How do you avoid value traps? And it's a perfectly reasonable question because value traps are a pain for value managers. But what people don't seem to focus on is those same kinds of stocks exist in the growth universe as well, right? A trap is just a company that winds up not doing as well as investors were expecting. And those stocks actually turn out to be more painful if they were growth stocks than if they're value stocks, for not such a weird reason, right? If you're a value stock, nobody expected all that much from you. They're still disappointed if you do even worse. But if you're a growth stock, if people were expecting wonderful things out of you because you were Peloton and were going to sell a bike to everyone on earth, when you fail to live up to that, there's two problems. One, your fundamentals are worse, but two, your valuation drops, right? That growth premium you had, you're no longer worthy of. And whether you're Peloton, whether you're Netflix, whether you're the whole series of growth stocks that have turned out to be traps in the past year, one of the interesting things that's gone on in the past months is this has actually been the worst year to be a disappointing growth stock relative to growth stocks. So, right, it's been a lousy year for growth stocks, fine. But the stocks that have done excessively badly relative to the rest of growth are those growth companies that have disappointed. And we think if you're going to be hiring active managers, it's important to recognize they're not going to be right every time. And one of the things that people are only relearning pretty recently is, yeah, it's really painful as a growth investor to turn out to have been wrong on a stock. And we think that pattern of growth traps doing particularly badly is set to continue for a while.
So Liz Ann, what about that? Obviously, when you talk about growth stocks, there are a lot of things included in that, a wide range of different companies. At the same time, in a world of rising rates, rising interest rates, all the things being equal, which they never are, growth is going to do worse because you're discounting that future cash flow, aren't you?
Well, and especially in an environment where some of these so-called growth stocks are actually the non-profitable stock. They don't have any earnings growth. They don't have any earnings. And I think when you combine that, which those types of stocks, whether it's non-profitable tech, they were very narrative driven. They really represented one of the pockets of where speculative froth was the primary driver. And in this part of the cycle, those types of companies, those longer duration, eternal duration stocks, as you wait for that earnings stream in a rising inflation, rising interest rate environment, get absolutely hammered. The one thing I'd say, and it's a little bit different a take on the idea or concepts of growth and value, and I often describe it as lowercase v and lowercase g, is investing based on the fundamentals or characteristics or factors of growth or value. In fact, Bloomberg does amazing work on factors. And if you look over the last 3 months, over the last 6 months, sort of this era of tighter monetary policy, high inflation, rising interest rates, what's interesting is even within segments of the market that are mostly housed in the growth indexes, tech, consumer discretionary, communication services, it's the value-oriented factors that are working, that are leading, meaning stocks that trade or stocks that screen well on those types of factors, whether it's strong free cash flow yield, strong balance sheet, lower volatility, they've been doing well. So I think sometimes investors have to take off the blinders when they think about growth and value, because you can look for value in areas that happen to live in the growth indexes. And there are times where certain stocks that live in the value indexes don't offer a tremendous amount of value. Utilities, which have been popular stocks because of the defensive nature, are now trading at a record or near record positive or premium from a PE perspective to the S&P 500. That's not value in a traditional sense. That doesn't mean they've become growth stocks. They still live in the value indexes. So that's another way to think about the concept of a value trap, which Ben talked about.
So, Ben, I'm curious about your reaction to that. I suspect you might not entirely disagree because you talked about active investing. You were saying be careful about growth stocks. At the same time, there are these elements such as good old-fashioned cash flow and balance sheet and volatility and stuff like that. Within the growth sector, there may be still some good buys.
Yeah, I mean, well, first of all, there almost always are, right? It would be weird if an entire half of the market, and growth and value tend to be defined by halves, if there was nothing worth owning. So even a year ago, there were probably some growth stocks that were worth owning. And I would say we have a strategy that we've been running for the last year and a half where we're explicitly long undervalued stocks and short overvalued stocks. And one of the things we've found in recent months is some of the stocks we were short a year ago are showing up on the long side of our book because the market has really fallen out of love with them. And that's a natural, that is a natural process. And one of the things about growth and value and that people tend to forget, they are always dynamic strategies. Right? You buy a value portfolio, you come back in a year and some of those stocks aren't value anymore. Now, oftentimes those stocks that aren't value, it's a good thing because the market has said, ooh, this is actually something pretty cool. And the valuation goes up and they graduate to the growth universe. On the growth side, what you really want is for those growth companies that you owned at the beginning of the year to still look like growth companies at the end of the year. Because if they don't, it's probably because something quite bad has happened to them. And that's a piece people don't tend to recognize, especially when they're talking about a stark duration difference between growth and value. It turns out that dynamism, that rebalancing of growth stocks to value and value to growth means I think people overestimate the duration difference between growth as a strategy and value as a strategy by a large amount.
Listen, I want to give you the last word. I always throw you a curveball. Here's a curveball. Is the real answer here we should all lower our expectations from what they have been and what we should expect from our portfolio?
There's nobody that I know out there that does long-term capital markets expectations that has a lofty number in keeping with, say, the 10 years leading up to the pandemic, or even the 10 years up until the end of last year. So I think just where we are in the cycle, the fact that household ownership of equities is, as of the end of the year, even through the first quarter, was at a record high level. That doesn't bode incredibly ill for subsequent 10-year returns, but it does suggest curb your enthusiasm for excess returns.